Welcome to the DIY Wealth Canada podcast, a show by independent investors for independent investors. Join hosts Bob and Nelson as they discuss investing, personal finance, and much more, all from a fiercely self-reliant Canadian perspective. As a reminder, nothing you're about to hear is investment advice. Thanks for listening and enjoy the show.
Hey everybody, welcome to another episode of DIY Wealth Canada podcast. I'm Bob, along with me is Nelson. Today we're going to talk about when to sell a stock. This is an interesting topic because there are so many rules out there, and like, when do you sell a stock? Do you take the profit? There's so many different variables, so we wanted to explore and really dive into this topic. Nelson, what are some of the parameters that would force you to sell a stock?
I think there are, as unique as every individual investor is, everyone's going to have different reasons in order to sell a stock. And so we're going to talk about a few of them today. And, there are so many reasons that we can really just sort of touch on the most common ones, because at the end of the day, like I said, everyone is unique and there are so many different ways to invest out there. So keeping that in mind, we're just going to focus on the main ones. And so I'm going to talk about one reason specifically that's more dividend focused, which is a lot of people will immediately sell a stock when it cuts the dividend. That's just a hard and fast rule. It doesn't matter what's going on behind the scenes. It doesn't matter what's happening in terms of the strength of the business or the reason for the dividend cut. They just decide, hey, it's time to get out, ask questions later. And I think, Bob, in 2025, what was it, about May, I think, was when BCE cut its dividend. And a lot of people probably listening held shares of BCE, very popular blue chip stock for a long time. And I think that's one thing that those people did, is it's cut the dividend and it immediately, they immediately sold it. So I'm going to ask your opinion first. Is that something you do in your portfolio? Do you immediately sell when it cuts the dividend? Or do you think, hey, maybe things are a little bit more complicated than that?
Yeah, I think it's a little bit more complicated than that. I think in BC's case, that was kind of written in stones a little bit, right? Like, they were in so much debt and the dividend payout ratio was just not sustainable. The yield was simply too high. So, from a shareholder's point of view, I was actually applauding the management cutting dividends, right? Because this is their way to get their books in order, get their finances in order. So that's long overdue, in my opinion, for BCE. And the way I look at it, I don't immediately sell if a company decides to cut dividends. But in BC's case, and I guess TELUS hasn't done that, but everybody's anticipating TELUS to do the same thing, is that, if they could get their books in order, reduce their level of debt. I think that's a very good method to continue holding the stock, and means that the management is kind of doing their due diligence to make sure the books are in order and company could improve. Now, what gets me is, for example, if the management comes out saying they're not cutting dividends, blah, 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 and then a few months later, they cut their dividends. That doesn't jive too well with me, because that seems to me the management is lying, right? So a case of that, I think, was it RioCan or is it H&R REITs? During COVID, I think one of the company's management came out saying, we're never cutting dividends, don't worry, things are strong. And then all of a sudden they cut dividends. That's when that didn't sit very well with me. So no, we don't immediately sell stocks when they cut dividends. Now, the danger of doing that is typically when a company cuts dividends, there's the price would drop very, very sharply. So when you immediately sell, you're selling at the low point of the stock and you're taking on a lot of loss, right? So I just don't see the reason for doing that for us anyways. Nelson, what about you?
Well, my logic has changed a little bit on this over the years, because, I really liked your comment when you said that a lot of times when a company cuts the dividend, it's stronger, that its financial health has improved. And that just makes sense because, you look at BCE was paying out something like 130% of its free cash flow to dividends. Not only is it paying out all of its earnings, but it's paying out all of its earnings and then some. So, you don't have to be a financial genius to figure out, well, where does the money come from? Well, they have to borrow it. There's no other place for it. All the cash flow is going out the door. So from that perspective, BCE is stronger financially now that it has cut the dividend. And so I think that has to factor into someone's thinking as well, because, ultimately for the company, it's a good move. Now, in terms of dividend cuts, a lot of them you can sort of see coming from a mile away. BCE, for probably a year, people were saying that it was going to cut. I looked at it from a, turnaround kind of perspective in late 2024. I thought it could turn around, and then they kind of abandoned this debt repayment plan and bought those assets in the US, which are going to take a bunch of money to get to where they want them to be. So at that point, it seemed pretty obvious that the dividend was going to be cut. It was only a matter of time. Now, I think what's much more interesting is when you have a company more recently like Northland Power. And for those of you who aren't familiar, this is a IPP, independent power producer, that is developing wind turbine power in places like off the coast of England, off the coast of Taiwan, et cetera. And then they partner with, sort of local investors, whether it's like pension funds or whatever. And basically they invest in these things, and then they retain an ownership stake and they develop them. So they get kind of paid to run them after, they're up and they're ready to go. Now, Northland went from, dividends safe. And then all of a sudden the new management team came in and they slashed the dividend. I think it was by 60%. And that really came as a surprise. Many people saw BCE's dividend cut coming. Not a lot of people saw Northland Power's dividend cut coming. And because of that, Northland Power immediately fell 30%. Versus BCE, it fell a long way until the dividend cut. But when it did cut the dividend, it was more than priced in. So the point of all this, and kind of what I want to say, is that dividend cuts are complicated. They happen for multiple reasons. And I don't think that the dividend policy should automatically dictate your decision-making process. So, just because a company has cut the dividend doesn't mean it should be sold immediately, because at that point, I think a lot of the bad news is already out. And like you said, Bob, you're kind of selling at the bottom. So ultimately, I think that it depends, but I would be more inclined to look at a company that has just cut its dividend rather than immediately sell it, because I think that at that point, you're sort of at the point of maximum pessimism, and that's usually when you're getting a good price. Not always. You have to analyze each individual situation, but more generally, I think that that's sort of what I would do. Is that somewhere you fish for ideas, Bob? Are you kind of interested in that? Or are you kind of one of those guys where it's like, hey, there's obviously something wrong here. I'm just going to avoid a dividend cut situation completely, in terms of adding new positions to your portfolio?
I think it really depends, right? If we already have a position in a stock, we may not add anymore. It depends on how much it is in our portfolio. And in BCE's case, we didn't add more, we just continue to drip. But if you really are one of those bargain hunters, and you don't own that stock in your portfolio, maybe it makes sense to go in and strategically buy some. I wouldn't back up your truck and load up on the stock. I would limit your exposure. But that certainly is a good way to bargain hunt a little bit. So that's definitely something, an interesting investing ideas. So I want to talk a little bit on a macro level in terms of when to sell a stock. For me, I think I look at it whether the business has fundamentally changed or not, right? Like we just talked about dividends and stuff, but sometimes you have to look at from a macro level. So what do I mean by the fundamental of the business has changed, right? So it could be like shrinking revenue, persistent losses, increasing in debt, right? Reduction in competitiveness, or major leadership dysfunction or changes, or the biggie, and typically it doesn't happen, is major shift in business strategy, right? So if you are investing in TD and all of a sudden TD decide to exit the banking sector and go into energy, that's a big no-no for me. I would sell it. I mean, that would never really happen as drastic as that. But one example I could think of is Intel. Right? We used to own Intel, and Intel used to be leader and innovator in chip designs and manufacturing. They were leading everybody. Moore's Law came from one of the founders of Intel, right? But like TSMC and Samsung really beat Intel over the last, I'd say, a decade, where Intel was falling behind consistently, and like people are just not, like, consumers just don't believe in Intel. And like I mentioned, TSMC, Samsung, even AMD, Nvidia. I mean, Nvidia is not really. Yeah, I guess they're designing chips for GPUs, but like the technology is advancing so quickly, Intel's always playing catch up. And then all of a sudden you have Apple, who used to use Intel's chips, shifted and announced the Apple Silicon. That was a game changer for Intel, because now they really saw their market shrinking. So that's one reason for exiting a stock, is like they lost their innovative edge, they lost their competitive edge, and they're playing catch up. And it just doesn't make sense to continue to invest. And that's when we pull our money out. We exited Intel and reinvested that money elsewhere. So that would be one. Nelson, have you had any examples of similar experience where you would exit the stock because their fundamentals have changed?
Yeah, I think that's a fantastic reason for selling. In fact, for me, that's the number one reason to sell. I look at it like kind of from a slightly different perspective of that. And we're mostly going to talk about the same thing here, where it's like, because I look at sort of the competitive position in the market and kind of the threats that the company is facing. And what I mean by that is, Bob used TD Bank as an example. And it's like, well, what's happening with the Canadian banking market? And I look at that and I say, okay, is there a sort of a fundamental reason why TD will lose market share, will be beaten by its competitors, et cetera? And in, the Canadian banking world, no, I think TD is very strong. I think that most of its competitors are very strong. Using a different name, Laurentian Bank was consistently a worse performer than its peers. Their branch network was just not as good. They didn't have the sufficient returns on equity, returns on capital. Their efficiency ratio was terrible compared to its peers. And so I could look at that and I could say, okay, this is clearly a weak link here. And no matter how cheap it might appear, no matter how high the dividend yield might appear, it's very clear to me that this is the weak link compared to its competitors. And for a year or two in, I'm going to say like 2017, 2018, I owned Laurentian Bank because it was traded something like 6 times earnings. It was incredibly cheap versus everyone else. And that was a mistake. And I sold it. And I think I lost a little bit of money on it. But at this point, it doesn't matter because it was so long ago and that money was cycled into a better company. So absolutely, I think that, you have to look at the competitive nature out there. And the other thing, too, you have to look at is sort of your thesis for buying the stock in the first place. And if your thesis for buying the stock in the first place was, to use the Laurentian Bank example, hey, I think that this company is going to continue to gain market share, it's going to improve return on equity, and so on, these things that you expect it to do, and then it doesn't do those things, then you should sell at that point because it's not doing what you think it's supposed to be doing. And ultimately, this comes to another sort of reason that I see people to sell. And Bob, I'd love your opinion on this, because I think your opinion on this is going to be very similar to mine, which is people wait until a losing stock gets back to their break-even point and then they sell. What do you think of that strategy?
I think that's a terrible strategy. If the stock has no long-term profitability outlook, what do I mean by that? Is that if you just don't, like, a good question I would ask myself is, if I don't own this stock today, would I invest in it? If the answer is no, then why would you continue holding on to it, right? If the answer is maybe, then yeah, okay, maybe it makes sense to continue holding on to it. Yeah, sometimes you just need to cut your loss, right? And I mean, that also depends on where you're holding your stock, right? If you're holding in a taxable account, when you sell, you get capital loss and you could offset capital gains. So that's where one of the reasons for selling would be tax loss harvesting, right? And we have done that in the past few years, where if you have capital gains during the year and maybe that's knocking your tax bracket up to the next level, then you could sell something that you're losing money on and then offset your capital gain that way. So that's a good method. But yeah, I think thinking that the stock would recover to your cost basis, it may never happen, and it may force you to continue holding onto a losing stock and just holding when you could reinvest your money elsewhere that would be more profitable for you. Now, I'm not saying you shouldn't hold on to any losing stock, and I'm not saying that. It's just that you need to evaluate and figure out, hey, is there a recovery point, right? One thing I mentioned maybe this a few times on the podcast, where I certainly have written that my blog is, we bought Manulife, or I guess I bought Manulife when I was first started working, and I was before the financial crisis, and I lost quite a bit of money. I didn't sell because I was like, well, people need insurance, and it's paying dividends. Sure, it cut dividends, but again, kind of goes back to our talking point number one. I thought they'd cut dividends because they needed to balance their books, so I decided to continue holding on to Manulife, thinking that eventually it'll recover. And sure, the recovery path took very long, because if you look at Manulife's stock price, it was flat for many, many, many years. It wasn't until recently it started going up. So was it a good strategy for us to hold on to Manulife? Maybe, maybe not. But sometimes you just have to have a little bit of patience, and eventually it pays off. But would I have sold it and switch over to something else, like a bank stock? Yeah, that probably could have been the case. But sometimes you may make mistakes. Sometimes they pay off, sometimes they don't. So yeah, it's not a clear cut. I know I said terrible idea, but you kind of have to evaluate your timeline in terms of, hey, do you think this company is going to recover within the next year or two, or is it a longer ride? And really, you need to ask yourself, are you okay holding on to it for 5 years, 10 years? If the answer is no, then it's time to sell. Nelson, what about you?
Well, I agree with you. First of all, is that the selling at the break even is generally not a very good idea. I would not recommend that anybody do it. I certainly don't do it. Ultimately, I think that the market doesn't care what you paid for a stock. All the market cares about is what the stock is valued at. And, the Mr. Market analogy of sometimes Mr. Market is pessimistic and he will offer you a lower price than what your stock is actually worth. And sometimes he's very, very happy and he will offer you a much higher price than what your stock is worth. But ultimately, the price you paid did not matter in that at all. Mr. Market is going to do Mr. Market things, whether it is, to your advantage or to your disadvantage, depending on whether you hold it or not. So I think from that perspective, you have to realize that. And then at that point, you want to sell something when it's being traded for a, higher multiple than what you think it's actually worth. So saying that, I think that ultimately, selling something that is, like you have to make your own decision and you have to sell, based on other reasons than just the price you paid. That's really what it comes down to. What about like, Bob, how do you feel about people? Okay, I think the market is overvalued. I think that, Trump is going to do something stupid and going to cause the market to decrease. I'm talking about like these big macro calls people have, and then they say, I'm going to sell stocks based on these macro calls. What do you think about that as a selling strategy?
Yeah, so before I get into that, I'll just talk about the stock overvalue or not, right? I hear a lot people say, oh, this stock is so expensive and don't buy it because it's expensive. And I'm like, kind of ask them, like, what do you mean by expensive? And they're like, oh, the stock price is over $100. That's expensive. Don't buy it, right? And I kind of giggle a little bit because how do you say a stock is expensive just based on the share price, right? Like you can't do that. You need to look at like P/E ratio, PEG ratio, and all sorts of stuff, right? So, like for example, if a stock if a stock price is $100, but the P/E ratio is say 10 and the PEG ratio is 0.5, like PEG ratio is basically the P/E ratio divided by potential future growth in typically next 5 years. So the lower the PEG ratio, the better. That means the stock should grow. So when you have stock A at $100 with P/E ratio of 10, PEG ratio of 0.5, yes, the stock's pricing is expensive at $100, but compared to stock B at $2 a share and a P/E ratio of 50 and PEG ratio of 3, I would rather buy a stock at $100 with those parameters, right? So you kind of have to evaluate, and don't just look at the share price, because that's a red herring, right? And then the other thing is just dive into potentially why you would sell a stock. A stock maybe is significantly overvalued. And what do I mean by that? It's like if the stock is historically trading at, say, 20 P ratio, and sure, it could kind of varies between, it could suddenly go to 22, could go down to 18. There's going to be some swings with the P ratio, right? But if all of a sudden the stock trades at 30, 35, 40, it jumps up. As an investor, as a shareholder, you need to understand why it's significantly going up with the P ratio, right? Remember, P ratio is price divided by earnings. So if the price all of a sudden jumps, but the earning doesn't really go up, the P ratio is higher. So you need to understand why. Is it because something they're anticipating? Is it because the street is anticipating a huge earning coming up, therefore the price is going up? Or is it hype, right? A lot of time, what happens, there's a lot of hype behind, right now it's AI, so all the AI company jumps up when the internet.com bubble, it was everything internet. So, all the share price were hyped up and the earning was still relatively low. So you have these companies with P ratio 50, 60, 70, 100, etc. Right? So you need to really look at that. Is the stock overvalued or not? And if it's significantly overvalued, but you still believe in stock, you still believe in your thesis, maybe it makes sense to trim a little bit, right? One of the good rule of thumb is if you bought a stock at, if you invest a stock for $1,000 and then you have the stock price double, sometimes it makes sense to sell half of it so you get your cost back, and everything else you earn is just extra gravy. So that's one way to think about it. Now, Nelson, to answer your question in terms of the macro side of things, that's very difficult to decide. Like, would the stock market go up just because Trump said that, or so on and so on? I mean, if you look at long term, the market has a tendency to go up, right? The long term market return is about 8% or 10% if you include inflation, I think. So generally speaking, things are going to go up. Now, there's obviously noises, day-to-day noises, right? So, if somebody says like political policy or so on, the market may react. It may go down, may go up. but over the long term, it should continue to go up. So it's tough. Like if you're your buying or selling decision simply on some political event or potential announcements, you're basically timing the market, in my opinion. You may time it right, you may time it wrong. I don't know. I remember somebody I know when Trump first got elected many years ago, this person decided to sell everything because this person thought the market will tank for sure. And the person sold everything, set on cash. And guess what happened? The market went up. So, this person probably lost 30-40% gain, right? So it's extremely difficult to look at events and then just deciding, because you could get it wrong, or get it right, or it's very tough. So that's my opinion. So I tend to ignore these noises and just continue executing our strategy and continuing to invest. Nelson, what's your thoughts on macro events?
Yeah, I probably have even a more strong opinion on this than you. I think the vast majority of macro analysis, and I'm using the air quotes here heavily of analysis, because I think most of it is just bullshit. And you might as well not even bother. Like, there are so many things that factor into something like interest rates or the price of oil or whatever. And the average person has no clue. And the average, even expert, has very little clue. They're basically just flipping coins and they get stuff right and they get stuff wrong. And then people just point to the things that they get right. So I think that just follow your plan and kind of keep chugging away at that. Do fundamental analysis of companies. I think that most people can do that with some sort of success, and be patient. But Bob, what I really want to come back to is the point you were saying about the valuation and looking at the kind of the historical valuation, because I think that is a really, really underrated way to look at buying opportunities. And, like we're talking about selling, which I'll get to in a minute, but, that is a fantastic way to look at it. Ultimately, when you're investing, you're paying a certain amount of money for an earnings stream. And it makes sense to buy that earnings stream when people are a little bit more pessimistic about it, and then sell that earnings stream when people are much more optimistic about it. And I've had success where I've bought companies at, like a 10-year low in valuation and just watch them do quite well. For the people that follow me, that my strategy for buying Canadian banks is very simple. I just wait until they hit a 52-week low, and then I buy some more, because a Canadian bank at a 52-week low is generally the point of pessimism. I'm buying that earnings stream a discounted price. And it's a really kind of simple way for the average investor to look at that, where it's like, hey, is the stock expensive or is it not expensive? Well, let's look at kind of the last 10 years and see where it is. And, hey, it's at the upper range of the, like the 10-year valuation. Okay, this is maybe not the time to buy. Maybe it's the time to sell, or vice versa if it's at the low end of the range. It's a really kind of simple, powerful heuristic that one can use to just understand where we're at. And I'll put another one too, which is dividend yield. It's kind of the same thing, where it's like, I want to buy something at its maximum dividend yield because that indicates to me pessimism. It indicates to me a low valuation. And then I'm looking to sell at a high price, which would be a low dividend yield. Now, obviously, I don't, I'm not a trader where it's like, if something goes from a high dividend yield to a low dividend yield, I don't automatically sell. I might hold at that point, because ultimately there are other factors in play. So I'm going to ask you, Bob, about another one here, which is taxes. Now, when you sell, you have to pay tax. And you talked about there's tax loss harvesting, and there's certain strategies that you can use to minimize your taxes. But ultimately, taxes are to be paid on investment gains. Do you think that the selling strategy should be different inside of someone's TFSA or RSP, considering that capital gains taxes aren't owed on those sales?
Yeah, before I answer that question, just want to talk about the stock overvalue or not kind of thing, what you were just talking about, Nelson. Another thing I like to do, I mean, you could do a lot of comparisons, but if you're buying the Canadian bank, you could compare like TD, compare it to its peers and then see where TD sits in comparison to its peers, right? So if TD is trading a P ratio of 11 and a yield of say 4%, whereas all its peers are trading at a P ratio of 15, then that's kind of indicating to me that something is going on with TD and may be worthwhile to dig in a little bit. Now, obviously, some banks trade a little bit higher in yield compared to its peers. For example, Bank of Nova Scotia, CIBC typically yield a little bit higher than TD or Royal Bank. So you can't just look at yield alone, but look at the historical P ratio, historical yield, and then compare that to the peer. That may give you some idea whether the stock is overvalued or undervalued, whether you should sell or buy. Now, in terms of selling decision in TFSA and RSP, because you don't have to deal with the tax side of things, it may be easier to sell or I don't know. I tend to in these accounts like TFSA, RSP, I tend to just keep them compounding. So if a stock is doing well, I just hold on to them. I typically don't like to sell them. On the other side, because there's no capital loss, you kind of have the tendency to kind of hold on to them a little bit longer, try to see if it recovers. But at the same time, you kind of, if the fundamental is not looking good, you kind of just have to sell it and take the loss. So I think in some way, the decision-making point within TFSA or RSP in terms of selling, it's a little bit easier than taxable accounts. Because with taxable, you kind of have to think about what's your tax implication. At least for me, if I were to sell in TFSA or RSP, it's typically an easier decision for me because I just look at, basically I ask myself, is my money better off invested elsewhere? And if the answer is yes, then I make that selling decision. Nelson, what about you? Do you see it differently between taxable and tax advantage accounts in terms of selling?
The short answer is no. I run all of my accounts the same. And like you, I try to take a long-term approach inside of those accounts. So whether it's a RSP or a TFSA, I just try to follow the same kind of general selling strategies that I would with a taxable account and not worry about the taxes on that part so much. So ultimately, I think that a lot of people, a lot of investors are just too impatient when it comes to selling. And I think that is a mistake that I want to avoid. So by taking a more long-term approach, I can hopefully avoid those mistakes of, selling something when it's down or selling something when people are pessimistic or whatever. What I want is I want to own good companies. I want to own them over the long term. And that doesn't really matter whether I do it in a TFSA or a RSP or a taxable account, because ultimately I know that the compounding takes a while. So I want to take that kind of long, patient approach. And ultimately, I'm just not the kind of investor who does these trades or anything like that. I just want to hold and go and live my life and do whatever.
Absolutely. And I think one of the things I want to point out is if you keep buying and selling the same stock kind of thing, you would never, within a short period of time, you would never get these multi-bagger investments, right? To get, 2-bagger, 3-bagger, 4-bagger, or even higher, that takes a long time, takes a lot of patience, and just let the stock price compound over time, right? If I look at our investment portfolio, we have multi-baggers where we bought the stock early on and we just kind of left it, and it has appreciated in share price over the years. So if you're always thinking, hey, I get 50% return, it's time to sell and then buy something else, you would never get those multi-baggers. So that's something to keep in mind as well.
Yeah, Bob, let me ask you, just in terms of your portfolio, what percentage of assets would you say that you sell every year? Like in terms of turnover, it's very small, correct?
Yeah, it's extremely slow for us. Like right now, maybe over the last few years, we have sold a few more because we're holding a little bit too many individual dividend stocks overall. So generally speaking, I would like to trim the numbers a little bit. So we have been selling or exiting positions more than say 5-10 years ago. So, but overall, like once we buy something, we typically don't sell. We just let things compound. I think, Nelson, this is the case for you as well. Now, I do want to talk about this idea of selling in terms of when the stock price has been flat for many, many years. And if it's a dividend stock and the dividend growth is limited, do you sell or do you continue holding on? Nelson, what are your thoughts on that?
What I like to do in that situation is to look under the hood and see what's happening with earnings. Bob, you brought up Manulife earlier, and that's a terrific example of a stock that did like nothing for the better part of a decade. Like it just kind of hung around that $20 to $25 range, sort of from kind of 2011 through all the way to 2020. But when you looked under the hood, what you did see is that after a few years of sort of stagnant earnings was that Manulife was increasing earnings, especially from like 2015 to 2020 period. And of course, after that, when interest rates went up, Manulife's earnings kept increasing. And so for me, it's like, I held some Manulife at that point. I haven't held it as long as you, Bob, but I've held it for a while. And I just saw that the earnings were improving. The company's balance sheet was getting better. It was growing in Asia and so on and so on. It was doing all these things that I wanted it to do, but the share price wasn't doing much of anything. So in that situation, I was happy to hold because I bought more because it's the business itself is improving and I didn't care about the share price. Now, saying that, I'll talk about an example where it was stagnant and I eventually sold, and that was Canadian Utilities. Canadian Utilities, of course, has the longest dividend growth streak in Canada. It's well over 50 years at this point. And I was a fan of the stock. I bought it. And then I kind of looked under the hood after it just sort of stagnant and did nothing. And what I saw was just the earnings were flat, growing at a very slow pace. And you could see that in the dividend growth. Dividend growth for the last few years has been like 1%, 0.9%. Like it's just, they're technically keeping that streak alive. So for me, it's like the earnings didn't do much, therefore I want out, versus Manulife where it's, hey, the earnings are increasing, things are getting better. I think the share price will eventually catch up. What about you? What's your thinking there?
Yeah, that we used to own Canadian Utilities as well, and that was the exact same reason we got out. They were increasing their dividend payout by 1% or whatever minimum for a number of years, and stock price didn't really do much. So that was the reason we got out. So yeah, I think we're absolutely aligned here. I think we're getting up to the time kind of wrap up, but I just want to pivot a little bit and talk about when not to sell a stock, because we just spend a lot of time talking about when to sell a stock. So I just want to give some examples of when not to sell a stock. And the number one thing that comes to mind is market panic. I see my shares of market panics. There's the Brexit, the COVID-19, the whole Russian-Ukrainian war, the Silicon Valley Bank collapse. The U.S. debt ceiling that seems to come every so few years or so. There's been a number of tech sell-offs, so on. When there's market panic, it's not the right time to sell. You don't want to follow the herd. Typically, if you have a cash, that's a good time to buy. One example is when Trump announces trade tariffs for a bunch of countries, and I think that was like April last year. and the stock market dropped quite a bit. Was that the right time to sell? Absolutely not. That was probably the right time to buy because everybody's panicking and selling. So yeah, that would be not the right time to sell a stock. Nelson, do you have an example when is not a good time to sell a stock?
I'll add that if a stock goes down quite a lot because of a poor quarterly earnings outlook, whatever, I've seen companies announce that, their growth rate is going to go from 10% to 8% and see the stock sell off 10 or 15% on that news. I think that's a terrible idea to sell at that point. I think that the market overreacts to poor earnings outlooks all the time. And ultimately, just be more patient when you're looking to buy something. Like a business is not going to change from quarter to quarter very much. And if it does, maybe you're in the wrong types of investments. I know that I'm not in any investments where the business is going to fundamentally change from a quarter to quarter basis. And just keep that in mind when you see one of your holdings fall by 5, 10, 15, 20% after it releases disappointing earnings, as what will happen with a lot of different companies. The sexy, exciting tech companies are more likely to have that happen. But I remember in the summer when Sun Life sold off by 10% based on just a slightly worse than expected result from its U.S. dental insurance division. Like, I thought that was a major overreaction. And Bob, I'm like with you, where it's like don't sell in that situation. Look at buying more. The market is giving you a gift at that point. So I would be much more inclined to buy in those types of scenarios rather than sell.
Yeah, and the other thing is there's market panic, and then there's also media noise, right? I think we talked about this before, where a lot of these stock analysts, they have very, very short-term views. They're looking at, the next quarter or even the next 2 quarters. When they come, they provide stock analysis. So when they say, buy, they give a rating of buy or outperform, or, when they downgrade a stock, typically it's like within the next quarter or 2. So when you're trading at such a short-term view, because a quarter is 3 months or 2 quarters, 6 months, you're not letting the stock you're not doing it justice to the stock. Because like Nelson said, some companies may have a weaker quarter or 2, but then they have stuff in the pipeline. They'll see revenue increase significantly. So I would tend to ignore the analysts. Use that as a parameter. But just because an analyst downgrades a stock, it doesn't mean the stock all of a sudden it's worth this and you shouldn't touch, right? So that's something to keep in mind as well.
Yeah, I think the analysts are so short-term focused because so many investors are so short-term focused, and they just kind of feed off each other. And, they're both looking at it completely the wrong way is what I think. But Bob, I think we're out of time. So this was a great topic, fascinating. I really this is something that I like to geek out and think about, because I think it's one of the the hardest decisions to make in investing. And generally, I just think that most people listening would be better off to sell less. And that includes me. So yeah, this was a great episode. Any last words?
Yeah, a quote from Warren Buffett just jumped out at me. I think he mentioned about if you're not willing to own the stock for 10 years, there's no point of owning it for 10 minutes or something like. Also, something like if the stock market doesn't operate for 10 years, would you still buy the stock, right? So really, when you buy or sell a stock, really think about long term, not short term. So that's something to really keep in mind, because ultimately it's the long game. It's a long game you're playing when you invest in a stock, not a short term play there. All right, thanks everybody. I think we're up against time here. Nelson, as always, it's been a pleasure, and we'll talk again next time.
If you enjoyed the show, make sure you subscribe to never miss another episode. For more from Bob, visit his site at tawcan.com. That's TAWCAN, all one word. Nelson can be found at CanadianDividendInvesting.com. They're both on Twitter as well. Just search for Tawcan or CDI Newsletter. Thanks. See you next time.